Right now, while most investors are chasing the same AI stocks everyone already knows about, there's a completely different layer of this market building quietly underneath. And the biggest tech companies in the world are funding it with hundreds of billions of dollars. These are the companies that make artificial intelligence physically possible. By the end of this video, you are going to know exactly who they are and how to think about buying them the right way. Welcome to Market Authority. This channel is built for investors who want honest research-backed analysis, not hype. If that is what you're looking for, hit subscribe right now because we do this every week. Now, let us get into it. Before I name a single company, I want to give you the framework that actually makes you money, because picking the right stocks is only half the equation. The other half is knowing how to buy them. The companies I'm about to walk you through are high-growth infrastructure plays. Most of them are not yet generating positive free cash flow because they are spending heavily today to build something enormous for tomorrow. That means their stock prices are driven by future expectations, not current profits, and that creates serious volatility. The principle you need to hold on to is margin of safety. You want to be buying $1 of long-term value for significantly less than $1 today, not chasing a stock after it already ran 30%, buying during fear, not during excitement. The investors who win with companies like these are the ones who understand the business, enter at a rational price, and hold with real patience while the cycle plays out over years. Keep that in mind as we go through each one. The first company builds something that sounds almost boring until you realize how desperately the AI industry needs it. When a major tech company wants to train a large AI model, they cannot just walk into a standard data center and plug in. The power demands are too extreme, the heat output too intense, the computing density too high. These workloads need facilities engineered specifically for them from the ground up. That is exactly what this company does. They design and operate purpose-built AI data centers under long-term multi-year leases, which means once a customer signs on, that revenue is locked in and recurring. Their pipeline is approaching multiple gigawatts of capacity, putting them at real scale as a core infrastructure provider. Analysts consistently flag AI power capacity as one of the most constrained resources in the entire industry right now, and that is a durable tailwind here. The risk is that free cash flow is negative, the company is in heavy build-out mode, carrying debt, and the stock is priced on execution. If contracts slip or financing tightens, you will feel it. The company is Applied Digital Corporation, ticker APLD. Size your position to reflect both the opportunity and the real risk attached to it. And the next company has a very different kind of edge. Most investors misread this one entirely, so stay with me. This next company operates in two worlds at once. Digital assets on one side and AI infrastructure on the other. That combination creates volatility, but it also creates a financial advantage most pure-play infrastructure companies do not have. The digital asset side generates real profitability that helps fund the AI build-out internally, reducing dependence on external financing. Analysts have been strongly positive, pointing to the GPU hosting contract pipeline as the primary upside catalyst over the next 12 to 18 months. The valuation opportunity is that traditional investors discount this stock because of the crypto exposure, meaning you can get AI infrastructure at a cheaper multiple than pure play peers. If the AI side scales and crypto stays stable, that discount narrows and you get growth plus multiple expansion together. The company is Galaxy Digital. The risk is clear. Crypto sentiment moves this stock regardless of what the AI business is doing. Know that going in and size accordingly. Now here's a company that saw the opportunity, had the assets to act on it, and actually did. This company built its foundation in Bitcoin mining, power agreements, physical facilities, operational teams, and then made a deliberate pivot into AI and high-performance computing hosting. What makes the pivot credible is not just the announcement, but the counterparty quality behind it. They have signed agreements with well-capitalized GPU compute providers backed by serious institutional money, and sophisticated counterparties do not commit to multi-year infrastructure deals with companies they do not trust to deliver. Analyst confidence has been building as contracts grow and the revenue mix shifts away from volatile mining economics. Free cash flow is expected to improve meaningfully over the next 2 years as HPC revenue ramps. The valuation thesis is simple. The market is still pricing this partly as a miner. As the revenue mix shifts and institutional AI investors recognize it, the re-rating can be significant. The company is Cipher Mining, ticker CIFR. Execution is the risk. Transitioning at scale is complex and competitive. Reflect that in your position size. If this analysis is adding real value, please share this video with one person who takes investing seriously. And drop a comment below telling me which of these companies you're going to research first. I read every single one. Now let us keep going. The next company has one of the most interesting structural setups on the entire list. This next company sits at the intersection of two of the most powerful investment themes of this decade: clean energy infrastructure and AI data hosting. Their operations run predominantly on low-cost clean power, which gives them a structural cost advantage that competitors cannot easily replicate. Lower energy costs mean better margins and more competitive customer pricing as the business scales. On top of that foundation, they have built a growing HPC hosting business with multi-billion-dollar contract potential and multi-year lease structures generating recurring revenue. Analysts highlight the dual-theme positioning as a genuine differentiator. Clean energy moat plus AI infrastructure demand in one name. Free cash flow is improving, but the company is still in a heavy investment phase. The company is TeraWulf, ticker Wolf. The primary risk is leverage. Significant debt to fund the build-out amplifies downside if growth slows. Entry price and position sizing matter a great deal here. The next name is one you have probably heard of, but almost nobody's looking at it the right way. This company is one of the largest Bitcoin miners in the United States, and that label is exactly why most investors have not taken a serious look at what it is actually becoming. It has assembled an extraordinary land and power portfolio in Texas, one of the most favorable energy markets in the country, and is now directing that infrastructure explicitly toward AI and HPC data center development. Analysts who cover both spaces have noted that these assets would command a substantially higher valuation inside a pure-play AI infrastructure company than they currently receive under the miner label. That gap between perception and potential re-rated value is the core thesis. Free cash flow from mining fluctuates with Bitcoin, but the AI build-out is building a path toward more stable and higher multiple revenue over time. The company is Riot Platforms, ticker Riot. Bitcoin remains the dominant risk. A sustained crypto downturn creates pressure regardless of AI progress. Patience is not optional here. This next company made the pivot from Bitcoin mining to AI cloud hosting, and unlike most, it actually built it at genuine scale. Their GPU hosting footprint is approaching 3 gigawatts of capacity. That is not a pilot program. That is infrastructure that puts them in serious competition for major enterprise AI hosting contracts. Multi-year agreements are building real forward revenue visibility, and the annualized contract run rate has drawn consistent institutional attention. Analyst sentiment has grown increasingly constructive as the revenue trajectory makes this transition undeniably real. Free cash flow is limited near term as capital flows into expansion, but the path to positive cash generation becomes clearer each quarter. The re-rating from miner to cloud infrastructure provider is the valuation driver. The company is Iron Limited, ticker Iron. Execution risk at this growth rate is real. Contract delays and capital needs can create near-term pain. Buy at a price that reflects that honestly. The final company on this list is the purest play of all 7. No mining history, no pivot, no prior chapter. This business was built from the ground up specifically to be a world-class AI cloud infrastructure provider. They operate GPU clusters and full-stack AI cloud platforms across Europe and North America, and their customer relationships include some of the most technically demanding organizations in the world. When sophisticated hyperscalers choose you as an infrastructure partner after rigorous evaluation, that counterparty credibility is a genuine and durable competitive moat. Revenue growth has been strong and accelerating, and forward guidance reflects continued momentum into 2026 and beyond. Analysts point to both the growth rate and the European diversification as key differentiators. The financial reality to understand clearly is that this company is still generating net losses. It is investing aggressively for scale ahead of profitability, meaning the stock is priced entirely on future expectations. The company is Nebius Group, ticker NBIS. If expectations shift for any reason, the valuation resets quickly. Go in with a long time horizon and full clarity on the financial profile. Now, the most important thing I can tell you, the win. All of this means nothing if you buy at the wrong time. The best entry points for every single one of these companies will come during moments of fear. When AI headlines turn negative, when hyperscaler earnings spook the market, when rate concerns push a broad growth sell-off, that is when you look at your watch list and ask whether the underlying business actually changed or whether only the price moved. In this infrastructure cycle, the answer has consistently been that the business did not change. Data center demand kept growing. Power forecasts kept rising. Hyperscaler capex commitments kept expanding. What changed was the stock price, and a falling price in a fundamentally sound business is an opportunity, not a warning. The worst time to buy is after a 40% run when everyone is excited and retail money is flooding in. Build your watch list now. Identify your prices. Wait for fear to bring those prices to you. That is the entire game. To recap, Applied Digital Corporation APLD, purpose-built AI data centers, multi-year recurring leases, heavy build-out phase, Galaxy Digital, hybrid digital asset and AI infrastructure, internal funding advantage, valuation discount from crypto exposure. Cipher Mining CIFR, credible mining to HPC pivot, re-rating thesis as revenue mix shifts. TeraWulf, Wolf, clean energy moat plus AI hosting, Dual structural tailwinds. Leverage is the key risk. Riot platforms riot. Massive Texas land and power portfolio pivoting to AI. Re-rating thesis from miner to infrastructure. Iron Limited Iron. Impressive AI cloud hosting pivot at real scale. 3 gigawatt GPU footprint. Re-rating in progress. Nebius Group NBIS. Pure play AI cloud infrastructure. Hyperscaler quality counterparties. Aggressive growth investment phase. Profitability still ahead. None of these are guaranteed. All of them carry real risk. But the demand they serve is structural and growing. Every AI model in the world needs physical infrastructure to run on. The companies building that layer today are doing work that will matter for the next decade. Buy with discipline, hold with conviction, and invest with a genuine long-term mindset. If this video helped you think more clearly about these opportunities, please share it and explore the rest of what we have here on Market Authority. We bring this same level of analysis to every video. Thank you for watching. Everything in this video is for educational purposes only. Nothing here is financial advice. I am not a licensed financial advisor. All investing involves risk, including potential loss of principal. Please do your own research and consult a qualified professional before making any investment decisions.